Hey, this is Mike of WallStreetWindow here. I want to talk with you today about what's happening in the stock market because I believe last week was a very significant week, and I would say it was the fourth such significant week this year. Let me show you the chart so I can explain to you what I'm talking about. I think we saw uh, two big weeks this year at the start of January and then March that were market tops. Then in June, we saw the third big week where low was set in, and we saw a rally, a rally that was bigger than I thought it would be. It took the S&P 500 up to the 200-day moving average. That's the green line on the chart. Now, I didn't close above it, just touched it, then came, it came right back down even that single day. Uh, but I think this week's a major top. You see, in a bear market, that 200-day moving average acts as resistance. In fact, I take that as the very definition of a bear market because in a bull market, it tends to act as support. It'll get touched once or twice a year and make for a great buying opportunity. In a bear market, when you get rallies up to the 200-day moving average, it's an opportunity to get out of positions that are lagging the market that you may have losses on, and get use that to be defensive, to be able to have a cash position to buy when the bear market comes to an end. Now, Friday, the S&P 500 fell 141 points. The Dow fell over 1,000 points. But interestingly enough, the whole action that preceded that day is very similar to the way the market topped in March and January. And I wouldn't be shocked if, the decline we saw, let's say from March to June, something similar to that doesn't play out for the rest of the year. That decline took place over 3 months. So that would mean a decline now into Thanksgiving or something could very well take place, or even into December. Would that be the bear market bottom? We'll return to that question in a few minutes. But I want you to understand, when I analyze the markets, I look at the big picture. That moving average, for example, is critical for identifying the long-term trend that you're in. And then you take shorter term patterns to align yourself with that longer term trend until it changes. And at some point, this bear market will come to an end. But it's also important to look at other markets. And a critical market is the bond market, because changes in interest rate policy and the yields on bonds has a massive impact on the economy as a whole and on the stock market. In fact, the junk bond market actually declined last year ahead of the stock market falling. And it is actually uh, started to decline. It bounced with the market in June, but it actually started to fall before the stock market did. So it was giving us a big warning signal last weekend that I think that we talked about together. But you can see that in the chart. It broke down, last week. It was warning that the fall on Friday shouldn't be unexpected, but many people were indeed taken by surprise by it. And let me show you, this is the headline I'm looking at this Saturday. Dow, the headline, Powell comments fuel 1,000 point market rout. Powell warns of some pain ahead as the Fed fights to bring down inflation. So over the weekend and Friday, essentially what happened is the market dumped, and the media, and it's not just the so-called mainstream media, but the financial media on YouTube, the alternative financial media, the crypto people, everyone you see is blaming the market drop on Powell. They're wrong. They're absolutely wrong about that. How can I make such a statement? Well, what Powell actually said on Friday was nothing new. He had been making statements. I read his entire speech this morning. Everything in that speech he had said in interviews to the Wall Street Journal and in speeches that he gave in May and June and July. In May, June, and July. In May, there is a major article in the Wall Street Journal where he said he's willing to see a recession if that's what it takes to bring down inflation. He doesn't want to lower rates. He specifically said in an interview to the Wall Street Journal that he did not want to make the mistake. He says it was a mistake that was made in the 1970s. In 1973, the Federal Reserve raised interest rates to stop inflation. Inflation came down, the stock market fell 50%, and there was a mild recession, and the Fed lowered rates, and then inflation completely exploded. And he was saying that the mistake we made, or that was made back then, was lowering rates. They shouldn't have lowered rates so quickly, because then inflation exploded and it was worse. And he claims that if they, had kept them where they were, that maybe all that wouldn't have happened the way it did. And I wrote about this in an article. The Federal Reserve is hurting the stock market and doesn't care. I wrote on July the 6th, and I'm titling this YouTube video with the same title to reemphasize this fact that everyone now recognizes on Friday was more than apparent over a month ago. And in this article that I wrote, all I did was quote the article. I quoted directly what Powell was saying to the Wall Street Journal and explaining what I just told you on July the 6th. So what happened? A lot of people were fooled into thinking that the Federal Reserve was going to pivot, but these people were completely ignoring what Jay Powell has been saying consistently since the end of June. They've been ignoring that. Why were they ignoring that? Because the stock market was rallying, and they wanted to find a reason to believe that it would continue to go up. And what we've experienced since over 20 years now is that when the stock market would fall, the Federal Reserve would lower interest rates, and then the stock market would just come back. Now, 2008, 2009, it completely crashed, and it was a serious bear market, so it didn't just simply come back. But and so long ago, people have forgotten it. But everyone's memories are the corrections that have happened since 2008, 2009, 2011. The market fell 10%. There was a flash crash, and the Fed, Bernanke at the time, engaged in a QE policy in reaction. In 2012, he did the same thing. The stock market fell 10%, new QE. In 2016, the stock market fell 20% over a couple months, 5 months or so. And new QE was announced. In 2018, the Fed was raising rates into a 20% decline that fall. And Powell was Fed chairman at that time. What did he do? I'm not raising rates anymore. And then they actually lowered rates a few months later, and everything came back faster than ever. And of course, in 2020, crash, rates go to zero, things came back faster than anyone expected. That's what we've experienced. That's what we remember. And so many people expected the same thing to happen again. And I'm not just talking about day traders, Robinhood traders. I'm talking about the talking heads. I'm talking about the people you see on YouTube. All these people were repeating this line of a Fed pivot. Jim Cramer was saying there's a Fed pivot. So everyone was ignoring what Jay Powell himself was saying. And in his own words, I had it July the 6th right here. And he never deviated from that message. The point of this is not to say that I'm right and everyone's wrong. I'm wrong at times too. The point is to say that this talk of Jay Powell on Friday was nothing new. People just simply ignored it. And the real reason the stock market dropped as much as it did on Friday really had nothing to do with something Jay Powell was saying, which was nothing new to start with. In fact, he said the whole thing in the Wall Street Journal again Thursday, the day before his speech. The Wall Street Journal had an article saying all this stuff that he said, ended up saying. CNBC had an article the morning or the night or the afternoon before the Friday that he spoke, saying expect him to disappoint. He disappointed. Everyone that was paying any close attention knew he was going to disappoint. He was going to throw out the pivot. And he did. He did what was expected. So why the stock market fall 1,000 points? The answer is really simple, because it's a bear market. And that was a bear market rally. And the bear market rally ended last week, and people exited fast. And that's the kind of action you see in a bear market. So you got to throw out these people who just want to believe that it's a bull market when everything is telling you it's not. The market trend has been telling you it's not since January. And the thing to do is listen to the market trend, align yourself with that, ignore people like Cathie Wood. That's how to navigate the market. Now, the thing about it is no one can predict the future. We try to look ahead and make scenarios to understand what might happen, but what we can identify is what is really happening now. Bear market. And at the start of the year, I thought a bear market was coming. It did. But I also thought that we were going to see a situation much similar to that 1973 scenario that Jay Powell was talking about. In 1973, the stock market fell over a year. It bottomed in the second half of 74. It fell 50%. But during that decline, gold went up as the stock market fell. And gold did that in the first quarter of this year. I thought it was going to keep doing it, but it didn't. It peaked out and it started to fall. We'll take a look at the gold chart in a few minutes. But the thing is, I did a talk with Ike Iosif earlier last week, and he sent me this chart of the correlations between this action and different time periods. And this is 1973. The overlay, he's got 85%, but you can see what happened in 1973 compared to where it is now. In 73, the market was sliding just like it has been. Then it had a rally in the fall, just like the one now, and it went sideways for a few weeks, then continued lower. Now, he made this chart Tuesday, so I would say the breakdown has pretty much already happened. But, I mean, if it repeated the exact thing, we're looking at a decline of a bottom next fall, next year, not now. And the thing is, I don't know if it's going to play out exactly like that. It maybe bottoms in the first quarter. But I'm very suspicious that we're going to get a new bull market until at least the second half of next year, probably the end of next year. Why do I say that? Because it looks to me, the Federal Reserve is raising rates. And is going to continue to do so. They say that's what the Fed funds rate is projecting into the end of this year, likely into February or so, and then they're going to pause. That's going to pressure the stock market. Real estate prices around the country are softening. The real estate futures market is saying that there won't be a bottom in that correction in real estate prices until the fourth quarter of next year. So that's recessionary. So I don't think the recession, the softness in the economy, if you don't want to use the word recession, is going to end until the fourth quarter next year. And the stock market, as Ike was showing or said in our discussion, does not typically bottom out until you're within 3 months of the trough of the recession. Well, we're not there yet. That's second half of next year. So that's how serious the bear situation is. Now, you can get a double bottom. We could bottom in December or January and rally and then retest the lows, and that's the end of the recession. That could be what happens. You can see on this chart, there's a double bottom. You can see on the chart where he left of it, where he compares 2015, 2022. Then 2015, there's a double bottom. That's that 20% correction I was saying. That double bottom was in 2016. You can see his 1962 chart was a double bottom. You can see how in 2008 there's a lower double bottom. Basically, there's a bottom in the fall and a lower low in October. But these rallies then test of the low or minor new lows, they're pretty common. Same thing happened in 2002, 2003. So it could easily happen again. You got to be patient if you want to be buying stocks to hold them now. That's just what you got to do. And you got to use the ends of rallies like we've seen as a time to lighten up. Now, what about gold? Well, gold stocks fell too on Friday, fell 4.71%. That's what the GDX Gold Stock Index did. You can see it had a great run at the beginning of the year and then peaked, and it's come down because gold is getting hurt by the stronger dollar and the rising interest rates. That's what's happening. The Fed got more hawkish in June and July, even though people have ignored that lately, and that's impacted the gold market. And it's helped drive the price of the US dollar up. But gold, historically, when the stock market fell in 2020 and even 2008, gold fell less than the stock market and then came back faster. I think the same thing's going to happen again. In fact, in 2008, gold bottomed out way ahead of the stock market and then went into a new bull market where the stock market did. I think that's what, going to happen going forward, and why we got to keep watching gold. When you look at the price of gold itself, it's still above support at 1,700. And if it breaks that, then we're probably looking at a low somewhere at around 1,600, possibly 1,500. It just depends on how long the bear market plays out in the stock market. Is it a double bottom or not? At one point, does gold hold up against the stock market? It could easily bottom at 1,600 if 1,700 doesn't hold. But here's the chart that's the most important when it comes to gold. This is the gold divided by SPY, SP 500 ratio. It's still holding up. And that ratio, when it breaks out to the upside, goes through the high of June, it's going to trigger a massive run in gold and mining stocks like you've never seen. And I think that move is going to start next year. So I think that's what we're looking at when the markets. This is my big picture view of why the stock market fell Friday, the real reason it fell, where the economy's going, what's going on with gold prices, and what I'm thinking about the way things stand now. We always got to look at these markets. At least I look at them every week, but I'm not saying you got to look at them every hour. It's hard to interpret hourly market action because a lot of it is noise. The longer the trend you look at, the more meaningful the price action is. That's why the 200-day moving average is so critical in using that as the first step to creating an interpretive framework to understand what's going on in the financial markets. And so the day will come when we get back above that for real. But typically when you're in a bear market, you have a stage one basing phase that plays out. That's what that double bottom often ends up creating. So interesting times we're in, and we'll see what happens this week and in the coming weeks to come. If you're new to what I'm doing on YouTube, hit the subscribe button, then hit the bell next to it, and YouTube will send you an alert as soon as my next video is up, and I'll be talking with you later.